What if I told you the global smartphone market is heading for its biggest drop ever in 2026? After years of explosive growth, shipments are now projected to fall sharply to around 1.12 billion units. And this isn't just a small dip. This could signal a major shift in consumer tech and even impact major stocks like Apple, Samsung, and chip makers. So what's really going on? And more importantly, is this a temporary slowdown or the beginning of the end of the smartphone boom? Let's break it down. Recent industry projections are raising eyebrows across Wall Street. Analysts now expect the global smartphone market to decline significantly in 2026, potentially the largest annual drop on record. Here's what stands out. Shipments projected near 1.12 billion units. Growth momentum from the post-pandemic era is fading. Replacement cycles are getting longer. For investors and tech watchers, this is a major red flag. Because for more than a decade, smartphones have been one of the most reliable growth engines in consumer technology. But that engine may be losing steam. One of the biggest drivers behind this slowdown is rising memory chip prices. Here's the chain reaction. Memory and component costs are climbing. Manufacturers face higher production expenses. Retail smartphone prices stay elevated, consumers delay upgrades, and in today's high-interest, inflation-sensitive environment, consumers are becoming more selective. Simply put, phones are expensive, upgrades feel less urgent, buyers are waiting longer. This is creating what analysts call upgrade fatigue. For years, the smartphone industry relied on one powerful behavior, people upgrading every 2 to 3 years. But that pattern is changing fast. Today's smartphones are more durable, more powerful, and improving more incrementally each year. The result? Many consumers now keep their phones for 4 to 5 years or longer. That shift alone can dramatically reduce annual shipments, and this is exactly what we're starting to see globally. Not all regions are being hit equally. Emerging markets still show some growth potential, but major mature markets, including the United States, Europe, and China, are experiencing clear signs of saturation. In many of these regions, smartphone penetration is already near its peak, which means future growth depends almost entirely on replacement demand, not new users. And replacement demand is slowing. This slowdown could have ripple effects across the tech ecosystem. Companies potentially affected include major smartphone manufacturers, memory chip producers, semiconductor firms, mobile carriers. If shipments remain weak, revenue growth could moderate, inventory cycles could tighten, and investor expectations may need to reset. However, and this is important, this does not necessarily mean the smartphone industry is dying. It may simply be entering a mature phase. So the big question investors are asking, is this just a cyclical slowdown or a structural change? Bull case, AI features could spark a new upgrade wave. Emerging markets still have room to grow. Premium devices continue to command strong margins. Bear case, market saturation is real. Replacement cycles are permanently longer. Hardware innovation is becoming incremental. The truth, we may be witnessing the smartphone market transition from hyper-growth to maturity. So keep a close eye on this trend, because what happens in the smartphone market often signals broader shifts in consumer tech spending. If you found this breakdown helpful, make sure to like the video, subscribe to Finance Buzz with Harold, and comment below, are smartphones peaking or just pausing before the next big wave? Thanks for watching, and I'll see you in the next update.